And welcome to another episode of the Disrupting Podcast. A gloomy morning here on Monday, September 20th. Alex, how are you feeling?
I'm feeling all right. You and I have been talking about this for a while on Twitter. If anyone doesn't know, follow us on Twitter. We've been kind of mentioning about this for a while because the writing was on the walls. But hope that you guys listened. I hope that you guys had thoughts on what was happening and had a strategy ready. But
calling the forensic team to clean up all the blood, right?
I think there's gonna be more blood coming. So,
well, let's break down why the market is so shitty this morning and what we think, is fair to expect. And then, of course, share our very opinionated minds, right?
Absolutely. All right.
Where do you want to start, big dog?
We're going to go start off with how the SPY has been moving, as well as with what's going on in the overall global economy news-wise. So over the last couple of months, if you guys have been following me,
you want to pull up the chart too?
Yeah, absolutely. So looking at the SPY, we've been talking about this for a very long time, and it's been very interesting to see how it's been moving. So since 2008, it's been moving at a nice upward channel. This is what it's indicated by, that little green channel that you're seeing. And it's been steadily going up prior to COVID. Prior to COVID, it broke below that upward channel, and then it just started to vertically extend. And it's been always a hesitant way of investors trying to get in. But the thing is that it's starting to bite back. A lot of money has been going into the market from the Federal Reserve, more than we have ever seen in over a long period of time. We've seen purchases, like I tweeted in June of 2020, around $500 billion of purchases for repurchases, agreement operations, support effective policy implementations. They were putting in $500 billion plus on monthly between June and July. So I think a lot of this upward movement was purely artificial, a lot of support by the government, but things are coming soon. And we're seeing the repercussions of it. And I've been tweeting for a long time, for the last couple of weeks, stating we need to be hesitant because September and October, over the last, just overall average, it's not a good month.
Well, yeah, September since the 1950s, September has been known as the September sell-off. That it's the worst trading month of the year. And it tends to be more towards the end of the month, whereas last year, I guess it really started on September 1st, just after Apple and Tesla split. But
yeah, and then it just keeps going down after that. There's a little bit more of an uptick slightly at the beginning of October, then it just continues to fall. But needless to say, we just broke below some major support levels, where they just broke below the 25 EMA line and then broke below the 50 EMA line. And the 50 EMA line has always acted as a major support level for the SPY to bounce off of. It doesn't have the support level anymore. And the next major support level that could be retested is the 200 EMA line. And if it plunges below that, God willing, hopefully it doesn't happen,
so around 410.
410 for the 200 EMA line. But if it does not hold, I think the next major support level could be 370 at worst case scenario.
Jesus.
But again, worst case scenario. I don't want that to happen. No one wants that to happen. But the major contributing factor is Evergrande. What Evergrande's been going on, what's been happening over the last couple of weeks, couple of months. It's been pretty insane.
Not everyone's aware of this either, which is unfortunate. So for those who aren't, they should just know that this is the world's most indebted property developer. They're Chinese, but there's a lot of foreign institutions, foreign banks involved in this. So the fear is, if this thing crumbles, they default on all of these loans, it could have a rippling effect, not only just in China, but beyond to foreign markets, which I think we're seeing today because people are obviously fearful for all the right reasons. And I mean, heck, you and I spoke for about an hour on this on Friday. I was freaking out because I bought some options foolishly, thinking, oh my God, I'm not even, what am I thinking? and I got crushed this morning.
It happens to everyone. I stop the bleeding, you stop the bleeding, it is what it is. But the thing is with Evergrande is I'm not the only one that thought this. You're not the only one that thought this. Everyone that has kind of an education on what could potentially happen has these thoughts that this could be another Lehman Brothers situation,
Yeah.
um, where there could be ripple effect for a couple months of where's the next support level. There's going to be a bailout potentially happening, but the writing's on the wall with the chart. Since June 3rd, it's dropped over 1,100% to now. And today it dropped what, over 20%?
Yeah, just an opening market.
Yeah,
Well, it
and this
sounds
whole
like they're
month it
doing a
dropped
fire
like
sale over there because their cash flow situation is, I mean, it's looking dire.
$310 billion in debt and liabilities. So I'm not happy about that. And they generate substantial amount of revenue, and their capital, their properties, all of them. Like, this is gonna be bad. They own some U.S. securities as well. There's institutional buyers and holders from every place around the world that's invested into Evergrande. It's going to cause the ripple effect.
Well, and again, too, this is why I think a lot of people, and I'm just kind of speculating here, get really closed-minded. No one wants to hear the bears talk, but the reality is, we've known that this developer has been trying to scramble to pay its suppliers for a while. And I think on three separate occasions over the past 5 weeks, they've warned investors that they could default on their debts. So it's like just another reason why, yeah, we're not bears, but it's always important to keep a pulse on, any potential catalyst of this nature that could really be a driving, stake to the heart, right?
Yeah, and you and I, we're both bulls at heart. We want to see the market do well. We want growing companies to increase in value and just expand. We all want that. But in the same aspect, you have to be unbiased. You have to be able to have a strategy at hand to know when to exit and find the next entry, and to not pay attention to what the bears are saying, because some of them are factual. If you have a good source, then good. But to not pay attention to what's happening globally is, in my opinion, quite ignorant and can definitely hurt you. Smart money doesn't lose money.
Yeah,
Buying the dip all
it's
the
so
time.
much easier said than done, though, too.
Well, the thing is that if you don't look at the overall scheme of things, looking at the charts, looking at the global economic situation, if you just buy the dip just blindly, you're going to lose more often than you would make money.
Yeah.
So you always have to have a plan. And looking at the way that the Dow Jones is moving, looking at the Nasdaq, the SPY, all of them, this is not over with. The bleeding is going to continue.
Well, and I'll be the idiot on this podcast that will be the first to admit my own faults. That you and I have theorized a lot of this, and it's been very astute. But here I, didn't stick to my own plan, and I chased a little bit on Friday. And so, shame on me. I can laugh about it today because I know I was a fool. But you live and you learn. The other crazy
FOMO
thing.
is real.
Oh yeah. So there's a little bit of humanism right there. The one thing
Yeah.
though that I'll be curious to see is like how the banks respond. Like I already was reading that like some of the bigger banks that are already backing Evergrande have basically declined to extend, new loans, which I guess is expected. Um, but man, I just really this is one storyline that everyone needs to keep a pulse on. Um,
But also, to add on to that, it's not just Evergrande. There's multiple factors into this. The debt increase right now. If the debt doesn't increase, President Biden has already came out publicly stating that he doesn't want that to happen. But if the debt doesn't increase, I could see that even contributing even more to the market not growing, because that's a huge situation.
Yeah, well, you're absolutely right. So the federal government is meeting Tuesday and Wednesday of this week to discuss the tapering of stimulus. And while I don't think they'll just say, pull the rug out, I think if anything, they'll at least reveal their plan for, hey, here's how we're going to wean off everything we implemented in March 2020 to support or prop up the economy. And regardless, that's not positive news. The sentiment's going to be really low, and people are, I think, already anticipating that, right? We know that like Congress has been in and out of sessions just to keep things from going into a shutdown. But, if you ask me my opinion, and I'm a Labrador Retriever to all of this, I genuinely just I'm going with my instinct and my intuition. And I genuinely just think that we are on the brink of the correction that everyone feels is inevitable. Right? There's just the landmines in the market seem to be constantly growing. The seasonal weakness is combining with the uncertainty of like COVID-19, the Delta variant, which got me. I was double vaxxed, still got it. I think all that's impacting consumer behavior. I regularly drink LaCroix on these podcasts, and I can't buy a 12 pack anymore. I go on there and I'm buying 8 packs because they don't box 12 packs anymore, and I'm still paying the same goddamn price. So there's 25% right there. I went and bought a tub of ice cream the other day. I opened that fucker up, and only 3/4 of it was filled. Yet it was the full gallon. So inflation is real. Make sure you're getting extra bacon on your burger and not having to pay for it.
Hey, guacamole is always extra ruddy, but it is what it is.
We're seeing it everywhere, and I think
Right
if
on the
anything, why wouldn't everyone just put some precautionary measures in place, be mindful? I went to all cash this morning, and for the longest time, I've been telling myself, all right, I'm going to consolidate a bunch of my accounts into one platform. I currently have a Robinhood account, I have a Webull account, and I have a Thinkorswim account. And it's like, fuck, I just want to operate on one. So now I'm going to take this time, put them all under Thinkorswim. Thinkorswim, we'd love a sponsorship.
Okay. Yeah, I like Thinkorswim. I just think Webull's a little bit easier, but hey.
Oh, I love Webull. All right, correction. I'll have my fun account, then I'll have my long-term account. But we're cutting Robinhood.
Well, I've stopped Robinhood ever since long-term ago. But I'll say this is that's a very smart move. I myself, I have a long-term account that I trimmed a little bit last week as everything was slowly starting to go down as precautionary. But my small swing trade, yeah, I'm all cash there.
Yeah,
because we haven't seen this amount of a gap down over the last 6 months. We haven't seen that big of a gap down ever. And it's just going to continue to go. I think that retail investors are going to sell, and institutional buyers, they're selling as well.
Oh man, there's about 20% of the stocks in the S&P 500 right now that are down 20% below their 52-week, highs.
Exactly.
Just beginning.
So if they're being precautionary, you need to be precautionary. But one thing I will state right now is these are our opinions.
Yep.
Even with Dana and even myself this morning, I'm wanting to get back in. I'm seeing things bounce a little bit, but I implore you, look at a chart, do a little bit of analysis on your own before you decide to re-enter. If it's still way above the support level, there's more to go down. And I'd rather you be smart. Don't be emotional about it. FOMO is very
real.
It's very real, and it can definitely hurt you. So take the emotion out of it for a second. Look at the overall scheme of things. I think Tuesday and Wednesday could definitely provide a little bit of an entry point for some swing plays. But October, there's a potential that we could be seeing 370 on the SPY, and I hope not. But we have never been in a situation where so many factors were against the market. Even in 2008. 2008 was the housing market, everything crashed, Lehman Brothers, credit default swaps, you name it. This is, we never dealt with a pandemic like this, and we're seeing the repercussions. So just please be smart.
Well, and I think too, everyone, it doesn't hurt to think like a bear. Why not have a holistic understanding of the market so you can make better decisions, right?
Absolutely.
No one's going to fault you for that. It's just being smart. I think too, people are like, gosh, all right, Evergrande, they're going to get bailed out. Okay, that might happen in some facet, but the reality too there is like that act alone is going to send, a lot of doubt. It's going to change the tide of sentiment in the market, and that alone could trigger, a little pop of the bubble there. So
all the banks got bailed out in 2008 as well, man. I think people need to realize that Look at what happened in 2008. All the banks still got bailed out and still see what happens. I think that a bailout really doesn't mean anything in my mind at all. I think it's just going to make it even worse, like you said.
Yep. So,
That's my thoughts.
what's our final message here?
I say be smart, take your emotion out of it. Look at the bigger scheme of things, not just emotional. Don't you dare decide to buy without looking at a chart. If you buy without looking at a chart, you're being emotional and you're going to potentially hurt yourself and your portfolio and capital.
Well, and I think too, we're all conditioned to think, all right, my portfolio's down X amount. I'm going to just hold. I'm going to hold until it breaks even. We need to remind ourselves some basic math here. That if you own a stock that's $10 and it falls to $5, you've lost 50% of its value. But for that stock, for you to break even, that stock's going to have to go up 100%. Right? So just think of the feasibility. Be mindful of, taking precautionary measures and be safe. I think, Aesop's fable, the tortoise and the hare, slow and steady wins the race here. So I love all the advice here, Alex. And as always, continue, reach out via Twitter with any questions. We don't have all the answers, but we'll certainly expend our time and energy finding them, right?
Absolutely. No question. We're always here to help you guys. We're here to educate you. And I know a lot of people always want to hear the good things, the optimistic sides, and want to hear the bullish side, but there needs to be a time where you need to look at reality and see the other side. And this is exactly what we're trying to do. We're not trying to tell you to sell. That's not what we're trying to say. We're trying to tell you to be smart and look at the situation before you make any drastic decisions. Okay?
And finally, visit our Twitter and sign up for our newsletter. We're dropping it once a week. We already acknowledged, Evergrande and the FOMC meeting this week and our first newsletter, so it's free. Sign up and enjoy our Shakespearean writing.
Bye, guys.
Bye.